No clients were affected. No customers suffered as a result of our mistake.
That's J.P. Morgan Chase Chairman and CEO Jamie Dimon explaining at a shareholders meeting yesterday how his big bank lost $2 billion in trades. Paul Lindman, Scott Lynn, the morning update for a Wednesday. Our Aaron Katersky, ABC correspondent, was at that meeting, joins us from Wall Street this morning. And Aaron, Jamie was contrite, but he keeps his job and his money, $25 million in annual compensation.
He does, and they overwhelmingly, the shareholders voted to approve his pay package, and they also rejected a bid to strip him of some power. He's CEO and chairman of the board. A group of shareholders said that's too much power unchecked, but a move to strip him of the chairman title and appoint an independent chairman was rejected by most shareholders. So Jamie Dimon does remain rather unscathed. I think probably takes a reputation hit because he's been such a loud advocate for risk management and against any kind of Wall Street reform that could cut into the bank's profits.
Did he say anything to shareholders about this we haven't heard before?
Not really. And in fact, it seemed like he was rushing through his opening remarks, very quick remarks before they got on to the business at hand. He seemed a little fidgety. And he also probably knew at that point that the FBI had opened a preliminary inquiry into the $2 billion trading loss, which is by far the most serious examination that the bank faces so far.
That, of course, is trying to determine whether there was any criminal wrongdoing. What are you hearing, Aaron? Is there any word out there about whether it will lead to real problems for J.P. Morgan and Jamie Dimon?
Scott, if AIG was not guilty of any crimes and Goldman Sachs wasn't guilty of any crimes, and you know, it's hard to see, you know, what one potential loss could mean in terms of criminal wrongdoing. But the FBI, by matter of course, anytime there is a loss like this, is going to open a criminal investigation. They want to look at the disclosure. They want to look at the accounting. The SEC and the Federal Reserve want to look at those very same things.
Aaron, somebody asked me a question yesterday I haven't heard addressed. If there's a $2 billion loss, someone made $2 billion. Do we know who that was?
We know at least a good chunk of who it was. Most hedge funds who couldn't believe that they had a chance to sort of chip away at J.P. Morgan Chase like this, and so they were, you know, chomping at the bit to get hold of the other end of this trade that went bad for J.P. Morgan Chase. And I think most interestingly is that another unit of J.P. Morgan Chase was actually on the other side of the trade. Not a hedge fund, but a different part of the portfolio, which just shows how big banks are. And on one hand, it shows that, you know, that the bank is sort of, you know, feeding off of itself. On the other hand, it shows that there was at least some separation, and that, you know, that part of the bank was independent of the other.
So can we say then that J.P. Morgan Chase really didn't lose $2 billion here? It just went to a different
Well,
lot?
the difference is that this was on behalf of clients. This was a portfolio that you know, was managed by J.P. Morgan Chase on behalf of clients. So it's not exactly what Goldman Sachs was doing, you know, where, you know, the firm itself was on each side of a subprime mortgage trade. Here, this was all done on behalf of clients on the buy side, and so it's a little bit different. But J.P. Morgan Chase definitely lost $2 billion in 6 weeks.
Jamie Dimon at the outset kind of downplayed all of this and called the initial reports a tempest in a teapot. Why has he not been more heavily criticized for that type of reaction at the outset?
Well, I think he has been, and remember, a lot of the shareholder votes that were taken yesterday were actually done by proxy, and they were sent in before all this became public. And so the ones who showed up in person, I think, were, you know, rather muted in their response. But I think Dimon has taken a big hit to his reputation, and I think in Washington the bank has less of a leg to stand on in its opposition to Wall Street reform. We've heard everybody from President Obama on down say this kind of loss, this kind of risky bet is exactly why more reform is needed. And even Dimon concedes that they now have a test case.
ABC's Aaron Katersky speaking to us from Wall Street this morning. Aaron, thank you very much.
You got it, Paul.